Okay, and then we will also get started on the sampling exam. Okay, so yeah, and I don't expect you to believe me when I say we're going to finish this one, but I'm going to try. Okay. Okay, so we just got over materiality, and down here, I'm just going to go over kind of these types of evidence, and I'm not going to go too deep into any one of them, but these are just some things that when we talk about audit evidence, like, well, what are you talking about? What is evidence? And I think I mentioned earlier that I think in chapter 5 that evidence is anything that corroborates or refutes a management's assertion. In other words, anything that supports the financial statements is evidence. Anything that doesn't support is evidence. So it has to go either way. If it doesn't support or refute, the financial statements, it's not evidence. It's nothing. It's not relevant. So it either has to, like I say, support the financial statements or not support, or go against the financial statements to be evidence. And that's what we're kind of looking at here. Now, it comes from, it comes from a bunch of different areas that you can get this evidence. It isn't all documents. I think one of the things that a lot of people think is that it's all evidence. Now, do we inspect documents? Well, yeah, we definitely inspect documents. But that's not the only thing that we do. So inspecting documents, you expect to do that. What do you expect? What do you look at? You look at invoices. Oops. Purchase orders. Receiving reports. I mean, you receive something, whether it's a piece of equipment or it's inventory, whatever. Bills of lading is a really important one. Proof of delivery, not quite as important, but still up there. Sales orders, etc. So there's a lot of different types of documents that you'll inspect and get information from. Some are more important than others, especially ones that come from that have an outside connection, like a bill of lading is when you put something on a truck to be shipped. Notice that some of these other ones, like a purchase order, they make inside, the client makes that, so that's not as good of evidence. But a bill of lading is something that you can corroborate with a shipper. Okay, inspection of tangible assets. Things like inventory. Property, which is land, plant, buildings, use. Equipment, it's just equipment. Those are common ones. So one of the things that you do when we all know about taking inventory of merchandise, right? So merchandise is one of those things that you guys may even have been involved in taking merchandise inventories. But they, to take an inventory to see what exactly is on hand. But we do the same thing with tangible assets like equipment. Things like buildings. I mean, they're easier to do because the building doesn't usually move around. But and they're easier to audit usually, the equipment. But you can look at a place and they have a bunch of computers. Those computers will all have a tag on them, and that tag you'll see. Okay, this is item. This is equipment number 7842, whatever. I'm just making that up. But then you go and trace that. It should be on the books. That 7842. Or if you have something on the book that says 7842, you should be able to go find that piece of equipment, make sure it exists on the book. So tangible assets are one of those things that you'll go out and actually take a look at. Okay, now we come to things that are sometimes not as obvious. And one of those things is observations. Watch people perform attacks. I should say employees. Just watch anybody. So watching a client employees perform a task. This is actually really good evidence. And I think I mentioned this before. People will tell you they do things a certain way. And when you actually go see what they're doing, they do it completely different. And a lot of times they're not being jerks about it. It's just that that's how they think it's being done, or that's how they think it should be done. Or it could be even that they think that that's what you want to hear. But observing them is a really good way. And that is also, when you observe somebody doing something, that's firsthand knowledge. That is more persuasive because it's something that it's evidence you've obtained on your own, not getting it from somebody else. You've actually watched them do it. And there's a real art to watching people without being known that you're watching people. So sometimes there's, you talk to somebody, and while you're talking to somebody, what you're really doing is watching somebody else who doesn't think you're watching them because you're talking to somebody. There's all kinds of stuff like that. You don't want, sometimes when people know they're watching them, they start doing crazy stuff. But anyway, observation is a really good one. Another one of the ones that is maybe not so obvious is inquiry. A lot of times you're asking people. Ask the client employees about a task or an amount. Yeah, here's an important one. Ask the client's employees if they're aware of any fraud. A lot of times, well, a couple things happen. A lot of times people will say, well, you knew this was going on. Why didn't you tell anyone? Is it nobody asked? And a lot of times too, employees will sit there and not say anything. But if you ask them directly, they're not going to lie. There is something about this, hey, look, it's none of my business because I'm not doing it. But if you ask them directly, well, then, they're not going to lie about it. They'll say, yeah, we're doing this, this, and this. And then again, if you don't ask them, it's not like they're going to jump out and say, hey, you know what, we're overbilling the government by, they're not going to tell you. So asking, just plain out asking people is actually a really good and important audit step. Confirmations. Confirm items with third parties. I think we talked about the accounts receivable confirmations, things like that. So accounts receivable, if they have accounts receivable on the books, you send out a letter to their your client's customer and say, is this, is this okay? Recalculation is just what it says, recalculating. Reperformance is when you actually do a task. Usually it is an internal control, not always, but usually it's an internal control. And I think I talked about this, maybe I don't know. I think I talked about there was we had a American Navistar, we had a warehouse that did an inventory. Did I talk about this? But they had the inventory, they had more inventory than we expected. I can't remember. I'm the old auditing guy. Anyway, so we had this inventory. We got this. It was like kind of like out of the blue that I was inventory guy for some reason. Anyway, when I worked at Navistar. So anyway, we get this thing. Okay, you guys got to go up to Canada because they did an inventory and they have more inventory than they should, which is unusual. Mostly if you have inventory problems, you're too short of inventory. Why? People stole it. People. It was broken. They threw it in the garbage. A forklift ran it over. They threw it in the garbage. There's all kinds of reasons why you can have less inventory than is on the books, but you generally don't have more inventory. You don't have people like bringing in inventory and throwing it on the shelves, that you didn't pay for. So it was a weird thing, and it had to do with returns. When someone returns inventory, that we were giving them credit, we were not putting it on the books correctly. And so some things were put on the back on the shelf. Whoever sent it back was given credit, so they didn't complain. It was put on the shelf and it was never added into the inventory. So you had all this, I think like the first go around, the inventory wasn't off by very much because they didn't have very many returns. But then over a year, they ended up with something like 20% more inventory or whatever it was. So we had to go up there and we were talking about getting the controls, what were the controls? And we kind of got a number of different answers. It was really hard to figure out. And I don't think that the people that were doing it even really knew exactly how it was. So my supervisor, he tells me, go do a reperformance of how I take back inventory. Do it all the way from when it gets returned. So we went there, and sure enough, they had a return there. And I said, I'm supposed to do it. And it was a union shop, so I thought they were really going to they would say, no, you can't do that. In which case I would have just brought a union worker with me and we would have done it that way. But they're like, yeah, go ahead. So anyway, and I had to one of those things that was a scissor lifts or whatever that go up and down because the inventory was like stacked to the ceiling. The most terrifying piece of equipment I've ever been on. But anyway, I had to reshelf this thing and went through the process. And again, it kind of came down to that they had they were supposed to have like an approval, like that the inventory could be resold. So someone had to look at the inventory to see that it was resold. And that person would do it. Say, okay, this inventory can be resold. This inventory is defective. They returned it because it was defective. So we have to send that back to the manufacturer, or we're going to throw it out or whatever it is. And they would do that, but there was actually no accounting for either of those steps. That, whether it was put on the shelf or sent back to the manufacturer or thrown out, there was no actual steps to put it into the system. Even though in the system it was made as a decision, it wasn't it wasn't actually added into anything. So anyway, reperformance though, that's going through exactly what they did. That was one of them. Okay, analytical procedures. I don't know, I think we talked about this, didn't we? Maybe not. Analytical procedures are when they're usually done with ratios. Oops. And you're looking for plausible relationships. So plausible relationships between numbers. And I'll give you an example. If you have a sales increase, usually there's an inventory increase. Not always, but that is a plausible relationship. You know, if you have 3 stores and you flagging that. If you have 3 stores and you go to 4 stores, you know, and you have a sales increase, well, that new store needs more inventory. So it makes sense that the more sales you have, the more inventory you have. If that isn't the case, then you investigate it. So analytical procedures really just tell you where to look. Scanning data. All right, so look for unusual transactions or transactions that aren't handled the usual way. For instance, a sale that did not go through the sales journal. You know, that would be scanning the data. Why wasn't this sale? Why didn't it go through the sales journal like all the other ones did? Test of controls, substance tests, we've already done this. Okay. Did we talk about assertions? Completeness and all that kind of stuff?
No.
No? Okay. All right. What are assertions? Let's see here. Assertions are when management hands you the financial statements and says, these are our financial statements. And then one of the things about doing an audit is they have to have the financial statements done so they can hand them to you. When they hand those financial statements, it's sort of like implied, usually, in them handing it to you that they're complete. Right, that the financial statements are complete, that everything on those financial statements, that it, you know, if they have something on those financial statements, that it existed. So for instance, if they have a piece of equipment on there, that it exists. That if they show a sale, that it must have occurred. So these are all things that are sort of, sometimes they're implied, sometimes they're stated outright, but these are things that are in the financial statements that, you know, when management hands them to you, these are called relevant assertions, that it's sort of asserted that these are free of material misstatement, that these are what they, you know, fairly presented. And so that's what you test to. And so these are kind of the different ways that things could go wrong. So the assertions are different ways that things could go wrong. Are they complete? Well, maybe they're not complete. Do these assets exist? Maybe they don't. Could be through error, could be through fraud or whatever. But the assertions are sort of like the mostly implied, but sometimes stated outright. Those are things that are included in those financial statements when they hand them to you to be audited. And so that's what you test to. And you test to these assertions. Now, there are different groups that have different assertions. So the AICPA has their assertions and the PCAOB has their assertions. But they're really not that different. So it's not a huge difference between them. And a lot of times these are, they're just included in different ones. So for instance, if you see the AICPA assertions that there is an occurrence, right? Okay, well down here we have occurrence. Completeness. Okay, you come out here, PCOB, they have completeness. Authorization isn't in there. Accuracy isn't in there. Cutoff isn't in there. Presentation and disclosure is. Rights and obligations is. Existence is. Valuation and allocation is. So you can kind of see that most of these are kind of duplicates. And the ones that are not are pretty much included in some of these other ones. For instance, cutoff and valuation or allocation are going to be covered in those two. So we have something like cutoff, and by the way, it used to be that way. Classification, that is included in presentation and disclosure. So down here, presentation and disclosure, this includes classification. Accuracy is a kind of a wacky one, I'll talk about in a second, and authorization. But accuracy, we never say the financial statements are accurate. So accuracy is kind of the weird one there. Accuracy is this, that every transaction, there's the assumption that each of those transactions is accurate. We never say the financial statements are accurate, but any given transaction it's implied that it's accurate. So if management says there was a sale, it's implied that that's accurate, that that was a sale. And you'll test to that to see if it's a sale, but that's only at the transaction level. We never say the financial statements are accurate. All we say is that they're reasonable assurance about whether they are free of material misstatement. We never say they're accurate. We never say they're correct. But what we do say, is that in the ACCPA's though, their view of it is each transaction that you look at, if management has it on the books, it's implied that any individual transaction is accurate. So some of those things are things that are while it's true, they don't really talk about the entire financial statements. It's only for when you're doing testing or something like that. So anyway, these are the assertions. Then you'll test to this. Did the sale occur? Is the inventory complete? Does the inventory exist? Are they making up inventory? These are the things you test to. Okay, so coming out here, so this is a substantive test plan for asset accounts. So any asset that you have, so this could be for it could be for cash, it could be for accounts receivable. Inventory. equipment, whatever it is. You know. So these are things that we will test for if we are looking at any asset. Does it exist? Is it complete? So and these two are probably the most important ones. Existence and completeness, we spend a lot of time on these two. Rights. Rights and obligations. So do we have the rights to the assets? And just because you see a big piece of equipment on the shop floor doesn't mean that they actually own it. It might be that someone else owns it and they lease it. You know, so and two, it might not even be on the floor. There might be a piece of equipment that is not there because they're leasing it to somebody else, even though they own it. So, you know, rights goes beyond this, you know, the physical placement of the asset. You can't tell by looking at it whether they own it or not. What's the value of the asset? How is it presented in the financial statements? For instance, things like depreciation. You know, is a depreciation amount appropriate and that sort of thing? Okay. Now, generally, I think it's the very first thing we did. Okay, remember way back like 100 years ago when we did this one? Which type of account is easiest to prove? We talked about assets being the easiest, and then liabilities. And you go by the account. So the cash account, everything goes to the cash account, very important account, even though it's small. Right. So we have these revenues and expenses that go through there, payables go through there, inventory goes through there. Eventually everything goes through there pretty much. So looking at the accounts is one of the most common ways of doing it. Now, there's also in auditing a kind of new, this has come out in the next, we've always had these cycles, right? The revenue cycle, acquisition cycle, conversion cycle, production, and you know, and so on and so forth. So these cycles are not anything new, but the new thought is that, you know, auditing the cycle for some, you know, is more important than the individual accounts. The idea is that you get a bigger picture. Quite honestly, the testing for the individual accounts hasn't changed. You know, whether you put it in with the revenue cycle or if you audit the account by itself, the tests are going to be exactly the same. So, but you will have sometimes, you know, the different cycles that people will do audits of the different cycles. I'll tell you something kind of wacky. When I was going through school, they had a big, when I first started, it was the big 8. Then went down to the big 6. And then it went down to the big 4. They kept merging and merging and merging. And anyway, the Price Waterhouse was by far the most expensive CPA firm. Their audits cost twice as much as anyone else's. And they would do this auditing by the cycle. Everybody else just did the accounts. So I think that there's some hangover from that kind of with the cycle thing that kind of came back into vogue or something. But anyway, Price Waterhouse used to do auditing, but they were the only one of the big 8, big 6, and down to big 4 that were doing the auditing by the cycle. When most other people were just beating up the balance sheet and then, you know, backing into the numbers from the individual accounts. So anyway, it isn't like it's a new thing. It's been, audit has been done like that for years, probably 100+ years, but okay. Where's left here? Oh, we're almost done. Yay. Who owns the audit documentation? The auditors own it. So the auditors own the documentation. The client does not. And by the way, the client may say, well, I want a copy of your work papers when you're done. They don't get it. Because there's things on there that you don't want them to see, what's material. You never tell your client what's material. If they know that they can cheat, 56,000. Okay, well, we can cheat to 53,000. You never tell them what's material. And there's other things in those work papers. Sometimes it'll be personal in nature, investigating fraud and things like that, that are not just given to the client. So anyway, the work papers are the property of the auditors, and you say, well, what do they do with them? Why do the auditors want to keep these? Well, here's why they do it. They help plan, supervise the audit and even future audits. The big one is support for the audit report. If they get drug into court, the only thing that they have is the evidence so if someone says you did a bad audit, they say, no, we didn't. Here's the evidence. And work paper review. And this is the quality control of the CPA firm and of the individual audit. So it might be that they look at these work papers to see overall if the CPA firm is doing what they should be doing. It can also be for an individual audit. So someone can look through the audit and say, was everything done the way it was supposed to be done? Was it done to the audit plan? And was the audit plan adequate and all that kind of stuff? Okay, permanent file and current file. I'm not going to get into this too much. Permanent file is a file that you'll bring back every single year, and usually this just gets updated. The corporate charter, chart of accounts, organizational chart. You'll update that. Who came, who left, all that kind of stuff. The current file is only for the current year. So there's two files. This file you'll use every year. So every year you'll use this. The current file will only be used in the current year, because once you get into the future, it's not gonna, if there was for instance, an adjusting entry made, it's not gonna have too much of a bearing on the future of it. Okay. So current file. Okay, now here's some problems, and these will be something like you may have on the test. This is a good one. All right. Use the following information to answer A and B below. Okay. So during the audit of a client, a member of our team discovers an understatement of $50,000 in an expense recount. Okay, so there's an understatement of $50,000. Here's their information. They have total assets of $3,700,000. And for the audit, we say our overall materiality was $70,000. Okay. So the first one is quantitative materiality. And quantitative means what? What does quantitative mean? You quantify something. What does it mean?
Measuring?
Yeah, exactly. Yeah. So this is a kind of a measure. Usually we're talking about here, we're talking about dollars. So this is the dollar amount. Okay, so we found a $50,000 error. The overall materiality is 70,000. Is this $50,000? I have a question mark here. Is a $50,000 understatement a quantitative material misstatement? No, it's less than what we would call material. Hold on a second. Okay, so this is quantitatively not material. Okay, now there is something about this though. If you look at their income statement, so they have an understatement of the expense account. Now 50,000. What's that going to do to their net income?
Increase it.
Yeah, it's going to decrease it. Yeah, it's going to. So this. So for instance, if they made this correction, so revenues. Oops. So the revenues would still be 2,800,000. Expenses were understated by 50,000, so the expenses should be minus 2,000,000. So 50,000 on top of 2,780,000 is what? 2,830,000. This net income is going to turn into a net loss. So this will be a net loss of so this understatement of $50,000, this means that they have understated their expenses. So if they made this now this is one of those things that is a qualitative material misstatement. Okay, so let's go back here a little ways. So here's a qualitative one. So this is changing a loss into a gain. That's what they're talking about right here. You know, they changed a loss into a gain. It's not by a material amount, but there is a difference between a company that's losing money and a company that's making money. So coming down here, this is material. So the $50,000 misstatement. Oops. Into a gain or into maybe net income is a better way to put it in this case. So even though dollar-wise, it's not material, $50,000 is less than 70. Qualitatively, it is. So this would be a material misstatement. This company should be showing a loss, not net income. It should be showing a net loss. So that's a qualitative misstatement. It's not quantitative. Quantitative, it's less than the 70,000. But because it changes from a loss to net income, it is a qualitative misstatement. And there's other ones too. They show up there. If it violates a contract or something like that, those are things that are qualitative. That even though the dollar amount may not be enough, and in this case, it's not. But qualitatively, it is. So you're going to get one of these on the test, just so you know. Yeah, any questions on that? And so it could be, like I say, there's other ones too. Lose it. There could be other things too. It could be, let's say, reverse a trend. It could be that, for instance, things like management fraud that is normally not material because it's management, upper management, especially. Those are things that could be considered to be material because of who does them. So when we're talking about things that are qualitative, two things about it. First of all, what it is makes a difference. What the misstatement is important. A $50,000 error that doesn't change the, whether they're profitable or not. No, but ones that does, material. The same thing with somebody who violates a contract. If it violates a contract, it might be material, even if it's, theoretically a penny. It could violate a contract. So, these are all, it depends on what it is. So it's not just a dollar amount that we're talking about. So materiality is, well, we like to think of it that way, and probably most of our testing is focused on that. It's not the only thing that's material. So there are qualitative things that are material. Okay. Testing for assertions. Okay, so this is usually the flow of documents. we have our source document, invoice, receiving report, shipping documents. And the accounting department gets these and they make them into journal entries. They could be regular journal entries. They could also be in special journals like a sales journal or something like that. So source documents turn in journal entries. The journal entries go into the general ledger with all the accounts. They go to the trial balance that have account balances only, and then they go to the financial statements that we're all very familiar with. So source documents to journal entries to general ledger, trial balance. Okay, so tracing source documents to the trial balance would most likely be associated with which assertion below. Okay, so let's say we have the source document here. Let's say we have an invoice. And we trace that invoice to the trial balance. Are we trying to figure out if that trial balance is complete? Or are we trying to figure out if that asset or whatever this invoice is exists? And these are tricky. So if we've got an invoice and we trace it through the journal entries, the general ledger, and we want to make sure that it shows up in the trial balance. So it's included in the balance of the, whatever. So we're going to see the journal entry. We're going to trace that to the general ledger. It goes into whatever account. Just for example, let's say this is an equipment account, and that equipment account is complete, and then it shows up on the trial balance. Are we testing for completeness or existence?
Existence.
Actually, it's going to be completeness.
Mm.
Because we want to make sure that this item actually shows up here, that this accounts, whatever it is, inventory account is complete. So kind of going forward, we test for completeness. Now, tracing the journal entries to the source, let me get some arrows up here. Hold on. Okay, so this is testing this way. And so, that's for completeness. Okay, tracing from the journal entries to the source documents. Okay, so let's take a journal entry here. Let's make it a different color so we can read. And we're going to trace it to the shipping documents, for instance. So they're saying it's a sale. We want to make sure it is a sale. Did they actually ship it? So we got the sale. It says that there was a sale made. And we go, okay, well, let's see the shipping documents, because if it wasn't shipped, it's not a sale. So which one are we testing for here?
Completeness.
Nope. Existence.
Oh,
Sorry. Does it exist? Here's a sale. They said they made a sale on whatever, January 13th. Well, let's go see the shipping document on January 13th. Does the sale actually exist? Did it, or maybe occurrence is a better way to put it in this case, but did this actually happen? Was there actually a sale made? You go to the shipping documents and you'll see, was it shipped or not? Did it, is this a real transaction? Does the accounts receivable really exist? Did it actually get sent to somebody? So if you go from the source documents forward, you're testing for completeness. So this way is completeness. Let's. Okay, so going this way, let me see my insert. So this way is completeness. And this way is existence. I just say existence or occurrence, maybe there's because for some things that are transactional, did it occur? But it's going to go the opposite direction. And these are the two most common types of testing. You know, did it go? Did they actually? Is the item in the financial statements? And then going from the financial statements back. Okay, they say they have $5 million in inventory. Does it actually exist? Do they actually have $5 million in inventory? So completeness. And existence, and one thing that goes along with that is occurrence. And it goes the opposite direction. And it can actually go along through any of these. Okay, so let's come down here. You know, actually, I may run out of room here. Which of the following tests would be most associated with the existence? Tracing shipping documents to the financial statements, or tracing financial statements to the shipping documents? Are they asking for completeness? Oh, which would find existence. Which way would we do the testing for existence?
B.
Yep. Completeness. Be the other direction. So tracing the sales journal to the source documents, tracing this. Oh, wait a minute. Oh, that was a little tricky. So here's the sales journal. So say tracing the sales journal to the shipping documents, or the sales journal to the trial balance. Which one is it? So if you're testing for completeness, hold on a second. I did this one wrong. No, this is right. Existence is a financial statement. Does it actually exist? So completeness is going to be which way?
Left to right.
Yep. So switch it, taking the sales journal and tracing it to the trial balance. So sales journal to the trial balance. See, even I get confused. I've done this a million. I've actually wrote this question. It is tricky. But whenever you get an account, it's often you often do this in both directions. We're done. Hey, see, I told you guys we finished this. So it's common to test them in both directions. By the way, sometimes you see this called floor to book and book to floor. And what that means is that if there's something on the floor of the place, inventory, whatever, you're gonna check and make sure that it's complete. You know, I found this piece of equipment, is it on the books? I found this inventory, is it on the books? Are the books complete? So I take it from the floor to the book. Also go from the book to the floor, does this exist? They say that they have this inventory. Go to the book, from the book to the floor. Okay, you say you have this inventory, you go through the breakdown what that is in that inventory account, take some of those items that are in there, and then go find them on the floor. So you go both directions, floor to book, and then book to floor. Going past one further though, this is where you're talking about just the documents. It's going to be the source documents to the financial statements. But it's the same idea that you're going to go back and forth. So completeness and existence are the two main things. And for the most part, whatever account you're looking at, if those two are okay, the account's okay. If neither of those are materially misstated, then everything's okay. I had a kind of a funny one. I was doing an out of an engine plant, and they had all this finished inventory, and they had a couple of really expensive engines. This is an engine plant we made. It was when I was at Navistar. We made diesel engines for Ford, but had these kind of expensive engines. So I was like, oh, okay, I want to see what these are. Most of the engines are whatever, $4,000-5,000, whatever. And this one was like, $15,000. I want to go see what a $15,000 engine looks like. So anyway, I can't find them anywhere. I'm looking all over. I cannot find these things. And finally, I talked to somebody, and they said, "Oh, I know what those are. They have what they call mule engines, and these are engines they do to a certain specification, and then they test them. So they weren't actually in the inventory on the floor. These were actually engines that were never going to get sold, but they would take these engines and run them for 30 days at 80% or whatever, and measure the wear on them and all that kind of stuff. But these were what they call mule engines, and so they were made to exact specifications, and that they could be measured, and they were, like I say, they were never going to be sold, but they were part of the inventory. So anyway, okay, let's go ahead and take a break. We'll come back at, well, you know what? We'll go ahead and take a break, but I'm going to send you guys the multiple choice questions right now. So we'll go ahead and take a break, and I'll be back at what, 7:10? And I will send out the multiple choice questions here. Okay, so go ahead and enter these into the poll so you get extra credit. And again, don't be afraid if you're not 100% sure on one of these because, well, first of all, they're difficult, but second of all, your name, when I released to the group, your name is not, next to any of the answers. So All right, well, let's take a look see here. This statement is correct. B. Yeah, and the successor or the predecessor auditor wanting to talk to you unless they get permission from the bank because it's confidential information. Good. Yeah, material misstatements are generally substantive tests are required. Now, you might be able to rely on tested controls to reduce the substantive testing, but the primary use of the for getting dollar for material misstatements is substantive tests. Okay, this one is actually an important word there. Planning phase. And in the planning phase, the only one that we're going to be the only one that you're going to do in the planning phase is analytical procedures. So let's see. Tested transactions come after. You'll do them, but and by the way, analytical procedures, get used to that term because their analytical procedures are far and away the most effective way of finding where to test. To find, you look at financial statements, if you just look at them without putting any kind of context, it's hard to know what to look for. But analytical procedures will say, okay, there's plausible relationships. If sales increase, inventory increases. If sales increase, generally expenses go up, and things like that. Anyway, so analytical procedures are really important, and that's why they are required. One of the few procedures that are actually required by the AICPA. Because they catch so much stuff. It's something like 95% of the statements are caught through analytical procedures. Okay, number 4. To test for unsupported entries in the general ledger. The direction of audit testing should be from. Good. Yeah, general ledger. Testing from the ledger to the source documents. So everything that's in the general ledger should be, look at why is my spacing so weird on this? Oh, probably because I bold. Okay. Number 5. Yep. Good. Tracing from source document towards the general ledger. C, completeness. Good, good, good. C is correct. If you can't get the evidence, you shouldn't take the audit. These other ones you can get around. Internal control. Okay, if internal controls are bad, you just test more, do more substantive testing. The transactions do not have to be detailed online, and the manager's reputation consulting several. That's fine too. Okay, good. 8. To test the existence. Yep. Does it exist? They have it in the general ledger. Does it exist? I think this is the first class that got this one right. The predecessor has no obligation. The successor auditor has the obligation, not the predecessor. This is an actual CPA question. And yep, 8K. It's true that 10K will have the new auditor on it, but when the change occurs, the actual change whenever it occurs will be put in an 8K. Now, the 10K, when it gets signed off on, the new auditors will be on that, but there won't be any it won't be what an 8K is. An 8K is for anytime something substantial happens in the company. Well, this is really good. Okay, stop sharing, save it. All right. Stock foil. Oh, what did you mean? You know what? I'm not going to do the we'll wait on the sampling practice exam. There's no way we could finish it anyways. So I'm going to send out the chapter 5 and 6 exam after class. Give me like 15-20 minutes. I just want to check and make sure I'm setting up the right thing. But anyway, so I'll send that out. It's due on a week from this Friday. You got some time to work on it. But anyway, so the chapter 6 exam will be sent out. Check your email, and it should be there. Let's say in the next half hour, it should be there. All right. Okay. I'll see you guys in a week.
Thank you,
night.
Professor.
Thanks, guys.
Good night, Professor. Thank you.